There is a asset class, a boring asset class that most people would overlook, most people don't understand, but it is starting to scream a buy. It is starting to say, hey, we see what's happening coming forward in the future, right? The rest of this year in 2023. And we're getting to one of those points where it is a really good buy. And that is the asset class we have to talk about today. I'll get to that and a couple of things that are going on this week that are kind of like a train wreck that you just can't look away from. So we'll get to that and so much more. Stick around. Hey everybody, this is RC Peck with Fearless Wealth, and this is my weekly update where I look at the past week's news, information, price changes in the markets, and talk about what I think matters most. And whether you are 50 or 80, this matters because what we're talking about here are entire asset classes, which absolutely influence what is going to happen and is happening with your portfolio. So today we're really going to look at one main asset class, which is the bond market. I believe it is bottoming, if not bottomed. And this is really important because A, the bond market is massive. It's much bigger than the stock market. And most people over the age of 50 have a significant amount of their money in it. And it has not been a good year to be in the bond market or a 60-40 portfolio. But that possibly is coming to an end. So I want to jump over to the price charts and look at the bond market itself and show you what I'm seeing. If we have time, which we may or may not, I'll probably just sprinkle in commentary about the implosion going on with FTX. So look at the screen here. This is BND. There's no dividends reinvested. So kind of think of all the price charts I'm about to show you as an index. They're ETFs, but I'm not including the dividends. So this is without dividends reinvested. And all of these price charts, let me just look here. All these price charts are 15 years in length. So here is BND, which is basically the US bond market. And there's the '08 bottom right there. And that's where BND is now. It just did a double bottom. I believe that's where the bond market's going to bottom. Now, it's always dangerous to say this with I'm not going to say it with 100% probability, but there's a high probability that the bond market just bottomed. I think it sees the rates coming. I think it sees the Fed raising their federal funds rate to 5%, maybe 5.25%, but that's it. So there'll be what's called the terminal rate where they end up raising rates to 5%. If that doesn't change, or if it stays at 5% and comes down, I think we have a bottom in the bond market. So there's BND. It's an ETF. It tracks the US bond market. Let's look at some other ways to own bonds. Here's MUB, which is mortgage-backed, which is municipal bonds. And again, I'm looking at all these without dividends reinvested. And you see a very similar thing here. You see a bottoming here. You see a bottoming in price here. With MUB, it's about 102, just like it bottomed in 2020, just like it bottomed there in 2013. Yes, munis bottomed way lower in '08, but there is definitely a significant bottom happening in muni bonds. Okay, now let's look at corporate bonds via the symbol LQD. Again, I am not including dividends. And so I'm going to zoom out a little bit more on this one, and then I'll zoom back in. So let's look out to 20 years of this. So when you look out 20 years, let me see. I want to see if there's 25 years of LQD. So LQD goes back to 2002. And so we have this bottoming here. If you kind of roll your eyes across that price chart, the blue lines are kind of indicating where people, where the price has either stopped going up or stopped going down. And that's where LQD is right now. It tried to go below the bottom blue line, but it got stopped by buyers coming in here saying, no, that's low enough. And so it's very likely corporate has also bottomed too. And so we have the total bond market bottoming. We have municipal bonds bottoming. We have corporate bonds bottoming. Let's keep going on. Let's look at tips here. Now, I don't need to stay this far zoomed out, so I'm going to just go back so we can look at less data here. But here's the tips. So I don't know if I do tips going forward. I'm just looking at it like inflation protected treasuries seem like they're not really catching the bid. and they're below kind of a major support resistance line. So yes, I know tips were really good coming into 2022, but they're not really. They may have bottomed, but I don't think they have the same upside potential as others do. Quickly, let's just look at emerging market bonds here. Well, that doesn't look too good. That is an inverse. I mistyped the symbol. I put a negative sign in front of it. So here's emerging market bonds. Again, COVID bottom right there. Yes, there's more room to run to the downside. So I'd probably stay away from emerging market right now. Man, they just have such a problem with the strong dollar. But there's definitely maybe a shorter term bottom with this, but definitely US bonds are looking better than, say, emerging markets are looking right now. And then if we just look to US Treasuries, here is the symbol IEF, 7 to 10 year US Treasuries. This is what I see here. I see kind of this right here. So it broke below that. So this is 7 to 10 year Treasuries that they definitely took a very big hit. And it's very likely they saw this price right here and is bottoming. They still have some upside resistance with the top blue line, but I think at worst they're in a sideways trend, and at best they've also bottomed with other parts of the stock market. And then maybe let's look at one or two more. This is TLT iShares 20+ year US Treasury bond ETF. And this has been really, really hit hard. It actually had a triple top here back in 2020. And then in that time from the triple top in 2020 to where it is today, or just, where it did fall, it fell 46%. I believe that's actually the largest fall ever. And it's significant. So, I think that the Fed's going to get rates to 5% and then just keep them there for like a year or 2 years as they let the inflation get below 5%. Yes, inflation's coming down. I think that's an old story. It's coming down. The Fed wants to get their rates to 5%. They want to keep them there until inflation, whatever inflation they're looking at, CPI, core CPI, some other CPI, gets clearly below 5%. So they're going to hold them there longer than I think people expect them to, which means those shorter term rates, the 2 year, the 1-2 year treasuries, the price of them probably won't go up as much as the longer term ones, the 20, 30 years, even the zero coupon bonds, which is kind of like the NASDAQ 100 of bonds. Here's zero coupon bonds here. The symbol is ZROZ. And these fell, it's amazing, 59%. 59%. Kind of right around that it fell to. So we have some major bottoming going on in the bond market. And the bond market is massive. It's much bigger than the stock market. So two things. It's either bottomed or it's bottoming. And remember, all markets look to the future. So it's very likely that the bond market is looking to what the Fed is doing, going, okay, got it, Fed, you're going to move to 5%. We can start to bottom, or we have just bottomed looking forward. So let's talk about putting this all together. Bonds are important even if you never own them, because it's one of the 5 major asset classes on the planet. So what happens to them affects all the other markets. Now, here's something that's interesting. If you can get 4% or maybe 5% from a 10-year treasury, not yet, okay? A lot of people might say, look, I'll take a safe, or I'll take a guaranteed 4 or 5% for 10 years. Or I'll take that for 5 years. That once that money goes in, yes, they can pull it out. But the point I want to make here is once that money goes in, it's not going to go back into the stock market. I think a lot of money that's coming out of the stock market, for the first time since the early 80s, there's a competitor, there's a new kid on the block, and it's called, I can actually make something in a treasury. That hasn't happened since the early 80s. No one's been talking about owning a treasury for decades because it's just not worth it. So the stock market hasn't had competition. It has competition now. And that's going to start showing up more and more in 2023 as people go, look, bonds weren't giving me anything before. but I'll take that 5% guaranteed. And so that's going to put a lot of downward, or definitely more downward pressure on the stock market. Let me know where you think I got it right, where you think I got it wrong, what you think I missed. I always read the comments. It helps. Also, too, please like, subscribe, and comment, because it helps with the algorithms, and that means this video can get to more people, which would be great, because just the view and the review I do of the market each week, I personally believe it's an approach that more people would love to have. So that like and subscribe really does help, and I appreciate that. And lastly, hey, if you are curious about how we manage our clients' portfolios, we believe in people to retire strong, right? When you retire strong, you do not have to come out of retirement. You stay retired. You do not worry about the market, even if it goes sideways to down. That's what retiring strong is all about. And that's what we do at Fearless Wealth. We make sure our clients retire strong. If you're curious about that, you can just go to fearlesswealth.com/start, which that means you will get on my calendar and or our calendar, and we'll do a portfolio review. I'm having a hard time talking today. Anyway, thanks everyone for being in my world. I do appreciate you watching my videos, and I look forward to connecting with you next week. Okay, take care.